How would you protect your portfolio against a 50 market decline? Given that inflation is likely to continue with ongoing geopolitical events, we can't expect a few companies to prop up the S&P 500 indefinitely. So assuming some black swan event happens that causes a 50 market decline over a period of 1 year, how would you hedge? My hedge is not needing that money next year or even having any plans for it in the next 5-10 years. I'd only lose money if it's down and I need to withdraw funds. Those investments are for decades away, so I'll just wait it out. Money I may need in the next 5 years is in cash equivalents. If I had a goal 5-10 years out, I'd maybe consider a mix of equities and bonds, but this whole thing is a lesson in risk tolerance. If you're 50 cash, it will instead be a 25 net worth decline. Taps Temple. This time last year on October 14, 2022, the market bottomed and recovered despite the same problems you've mentioned in the ongoing talk of a recession. Invest in solid companies and hold. Solid companies are not companies that aren't making money. That's how you get whiplashed. Just stay the course and keep dollar cost averaging. A 50 caused by what? Inflation, pandemic, war in Europe, war in the East, etc., etc.? Let's hope none of those things happen. Wait. My hedge is time. As long as I don't need the money within the next 10 years, I am more than willing to ride out the storm. If you bought SP at ATH during the GFC at 1500, you still doubled to 3000 in 10 years. As long as you make food investments over a long period of time, don't do anything rash to time the market. Diversify into a different asset class? How would you protect your portfolio against a 50 decline? I wouldn't. B, because I can't time the markets. Hedges are expensive and take away from performance. And my portfolio looks how it should, so I don't own any BS pump and dump money losing Reddit stocks. If you personally feel the market will experience such decline, then you should be taking profits and moving into cash or a money market account that guarantees you close to 5. Marry rich. Wait. Get divorced. Take half. If you have a realistic risk profile based on your needs at retirement and your age, a decline should be absorbed without too much stress. Resisting the initial sell-off, everyone else is doing it, so shall I mentality has proven to be a great long-term way to avoid destroying your portfolio. Having some cash reserves to make prudent purchases while everything is low also tends to reap generous rewards when the market rebounds. My hedge has been putting a majority of my portfolio into a treasury bill ladder strategy. Buying T-bills across multiple timelines and taking advantage of their historically high returns helps me fight inflation and get consistent returns. Then when interest rates drop, I have the option to sell out of my longer-term T-bills and move that money into the stock market at the bottom and DCA back in. Also, 5 returns aren't too far off what you might make in the stock market and with no risk. I'm loving this option. Put cash in your mattress. 1. 25/50 bonds and CDs. Adjust based on tolerance and age. 2. Some money in HYSA. Reconsider this as rates adjust. 3. If you have enough money and want consistent returns and know what you are doing, covered options can reduce risk if used properly. If market drops 50 or whatever your tolerance was, move some cash to equities and stocks and consider it a win. HYSA or T-bill to get 5. Private equity to get 10. Ultimately, I'm invested into direct indexing, tracking the SP 500. A market crash has its best performance few months after, so I will not touch anything and just invest more cash. The goal being to not miss the performance back. Hedge with long dated at the money SPY put. For me, in the time of geopolitical strife, I invest in oil, technology, and the war industrial complex has never let me down. Keep 20 in cash, and the rest non-invested in high-yield accounts that I can liquidate quickly. Allocate some portion to bonds cash, or you accept the risk and likelihood that you'll have to ride out a deep drawdown at some point. Prepare your finances so that you can keep the money invested and wait for recovery. I would wait it out. I most likely will look for bargains to buy. Depends on your needs. If you are investing for the long run, and you are not leveraged, then there is actually no need to hedge. Market will bounce back at some point. If you want to monetize the drop, then it's a whole other discussion. Learn options so you can hedge appropriately. CCs to lower cost basis. Puts to make money on the decline, which should more than offset your long position. Time. Most of my portfolio is money I don't currently need. SPY puts long dated would be my thought. Something like 350 level is like $1, so you'd protect a PFO for a few $1000s, I think. Time. Don't sell. If you really wanted to just buy puts to hedge, you can custom fit them to protect against any decline you choose. But the more insurance you want, the more it will cost. Cash. SGOV. Holding cash is king. You can't really hedge against a 50 market decline, because by definition that includes everything you can buy and sell. After an event like that, everything with value including wages, real estate, stocks, debt, currencies, gets cut in half, leaving every OD exactly where they are relative to each other. Otherwise you stated a bunch of broad scenarios, all of which would require different hedges. Negotiation skills and debt hedge against inflation. International portfolio hedges geopolitical risk. Equal weight hedges mean reversion of a few companies propping the SP. If you are not willing to react with equanimity to a market price decline of 52 or 3 times a century, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get. Charlie Munger. Lol, don't have a portfolio but T-bills. Keep DCAing. I would keep buying through the decline and keep buying through the recovery. I don't need any of it within the next 3 years. If I was close to retirement, it would be through diversification into other asset classes to balance risk. Look up risk parity portfolios like the Harry Brown Permanent Portfolio or Ray Dalio All Weather. Managed futures, puts or shorting depending on the asset, long short equity mutual funds. By not selling. Why does everyone think we're going to have the biggest crash in our generation every year? Sell. I would sell 16.66 of your portfolio into SPXS or SQQQ will hedge a 50 decline. Sell Bitcoin. But y'all aren't ready for that conversation. 1/3 of my portfolio consists of leveraged shorts on SP 500. Nasdaq and real estate. The rest of it is oil and gas and military manufacturers. Bring on the apocalypse. Daddy needs a new Lambo. That would be a 2008 level event, so buy cheap OTM puts on safe products like LQD. Short regional banks, as we've seen how vulnerable they are already. And be long the dollar UUP maybe?